Somewhere in your 401k, there is a dollar that buys you nothing, not a bad investment, not a hidden fee, a normal contribution into a normal pre-tax 401k on a normal Tuesday. That will never fund a single day of your retirement. I know how that sounds. Let me earn it. Because that dollar has an age attached to it. It arrives earlier than almost anyone expects, and it arrives long before you stop working. So most people go on contributing for years afterward, building an amount they will never spend. I'm going to show you exactly where it falls, how close you already are, and what to do with every dollar after that. Everything you are about to see was run through a spreadsheet before it was written down. One household, real numbers, every input visible, because a claim like the one I just made is worthless unless the arithmetic holds. And the arithmetic is the entire point of this channel. So we start with the reason nobody has ever mentioned this to you. For 30 years, every piece of financial advice you have encountered has pointed in one direction. Maximize your contributions, capture the full match, defer as much as the law allows. During the years when you were building, that advice was correct, and it was correct without qualification. But look at who is delivering it. Your plan provider is paid a percentage of the assets in your account. Their revenue is a function of your balance. There is no bonus at any firm, anywhere, for the person who calls a participant and tells them they have saved enough. Your employer has a structural interest too, and it is more specific than you might think. Retirement plans are subject to non-discrimination testing. If the general workforce does not contribute enough, the highly compensated employees have their own contributions capped and refunded. So the company needs broad participation to protect the plans of the people at the top. Keeping you enrolled is not generosity. It is compliance. And the financial media publishes escalating targets because a headline telling you that you are behind gets read, and a headline telling you that you are fine does not. 10 times your salary by 60, 12 times, 15. The number climbs every few years, and it climbs for editorial reasons, not mathematical ones. None of this is a conspiracy. Every one of those parties is behaving rationally. The problem is that the entire information environment is built to answer a single question. How do I save more? And there is nobody inside it whose job is to answer the other one. Even the tax code assumes these accounts get too big. That is what required minimum distributions are. Starting at 75, the government compels money out of your pre-tax accounts on a fixed schedule, whether you need it or not. Congress built a mechanism to force money out of retirement accounts because Congress knew people would arrive with balances they never intended to spend. The structure of the law already concedes the point this video is making. The standard question is, how much do I need? And it produces an abstract, terrifying number that nobody can act on. 80% of your pre-retirement income, 25 times your expenses, 10 times your salary. Every one of those is a rule of thumb built for a spreadsheet rather than a life, and none of them describes yours. There is a better question, and it is answerable. What does my life actually cost, minus what is already covered, for as many years as I am likely to have? That question has 3 inputs. The first is what retirement genuinely costs. Not a percentage of your income, the real line items. And critically, minus every expense that exists only because you go to work. The commute, the wardrobe, the lunches, the payroll taxes, and the retirement contributions themselves, which vanish the day you stop. For most households, that subtraction removes 20 to 30% before you have changed a single thing about how you live. The second input is what Social Security covers, and just as importantly, when it starts. The third is how long the money has to last. So let me put a household on the screen and stop speaking in generalities. A married couple, both 40, combined income of $180,000, $300,000 already in a 401k. They contribute $24,500 a year, which is the 2026 limit. They want $95,000 a year in retirement, and their combined Social Security will be $60,000 a year beginning at 67. At a glance, the gap looks small. $95,000 minus $60,000 is $35,000 a year. That feels manageable. It is also completely misleading for 2 reasons. Social Security does not start until 67, so every year before that, the portfolio carries the entire $95,000 alone. And every dollar withdrawn from a pre-tax account is ordinary income. So to put $95,000 in their pockets, they have to pull considerably more than $95,000 out, which means the answer depends enormously on when they stop. The earlier they stop, the more years the portfolio carries by itself, and the larger the number has to be. That is why no fixed rule of thumb can work. The target is not a constant. It moves. Owen decides he is done at 55. His number, calculated properly for a 55-year-old in that household, funding $95,000 a year to age 95, with taxes accounted for, is $1,294,104. Owen has $1,099,989. That is 85% of the target. He is 15% short, and 15% feels like a rounding error against a number that large. He is tired, the balance has never been higher, and close feels like enough. So walk the years forward with him. From 55 to 67, there is no Social Security. The portfolio funds everything. To net $95,000, he has to withdraw $103,000 because the withdrawal itself is taxable income. 12 consecutive years of that out of a balance that started 15% light. Put that first withdrawal against the portfolio it comes from, and the problem becomes obvious immediately. $103,000 out of $1,099,989 is a 9.4% withdrawal rate. The widely used safe rate is 4%. Owen is drawing at more than twice it in his very first year, at the exact moment his portfolio has the longest possible time left to run. Then Social Security finally arrives and the annual draw drops sharply. From that point, it looks survivable. And for a while, it is. The portfolio runs dry at 74. Not at 95. Not at 85. At 74, with a decade or two of life still in front of him, and no way to go back and undo it. The damage was not done at 74. It was done between 55 and 67 when he was drawing the full amount from a base that could not absorb it. By the time Social Security started, the balance that had to carry him another 28 years was already too small to recover. And if he had been further off, 70% of the number, $905,873, he would have run out at 66 before his first Social Security check ever arrived. So take the real lesson from Owen, because it is not the obvious one. Being close is not close. A 15% shortfall does not produce a retirement that is 15% worse. It produces a retirement that ends 21 years early. The relationship between how short you are and how badly it fails is not proportional, and that asymmetry is exactly why you cannot do this by feel. 4 inputs decide your number: your real annual spending, when your Social Security begins, how long you plan for, and what real return you assume. Change any one and the answer moves. So it is worth seeing exactly how much. Here is the same household, funding $95,000 a year to 95, taxes included, at 5% real growth. The only thing changing is the age they stop. Stop at 50, and they need $1,482,197. At 52, $1,412,415. At 55, $1,294,104. At 57, $1,205,042. At 60, $1,054,044. At 62, $940,376. And at 65, $747,660. Look at the direction of that. The number falls as you wait. Every year you delay, the target drops by roughly $60,000 to $80,000 because there are fewer years to fund and fewer years standing between you and Social Security. That matters more than it first appears. Your balance is climbing while your target is falling. 2 lines moving toward each other from opposite directions. Most people picture themselves chasing a fixed number that sits still and waits. It does not sit still. It comes toward you. And because it does, the crossing point arrives considerably sooner than anyone plans for. Now the input that moves the answer most, which is the return assumption. Take the 55-year-old. At 5% real, the number is 1,294,104. At 4% real, it rises to 1,423,563. At 3% real, 1,581,623. That is a swing of nearly $300,000, driven entirely by a number you do not control and cannot know in advance. Which tells you something important about how to treat it. Pick conservatively, because the cost of being wrong in one direction is a slightly later retirement, and the cost of being wrong in the other direction is Owen. The same logic applies to longevity. These figures fund to 95. Model to 90 and the number drops. Model to 100 and it rises. There is no correct answer, only an asymmetric one. Running out of money is far worse than dying with some left, so plan long. Everything on screen so far belongs to one specific household. Your spending is different, your social security is different, and your timeline is different, which means your number is different too. If you want to run these exact calculations against your own figures, the calculator built for this video is in the vault, along with every other tool we have made. Members get all of it. The link is below. Vincent is the same household, same income, same contributions, same fund, same everything. The only difference is what he does when he gets there. He crosses his number at 57. At that age, his target is $1,205,042, and his balance is $1,320,694. He is over the line. Nothing happens. No letter arrives. His statement does not congratulate him. The contribution comes out of his paycheck in the same amount on the same day it always has, and the only thing that changes is that the balance keeps climbing. There is no mechanism anywhere in the system designed to notice this moment, which is precisely why almost nobody does. So he keeps going exactly as he has been told to for 30 years. By 65, he has $2,185,220. His number at 65 is $747,660. He is funded roughly 3 times over. Those extra 8 years built $864,526. Now ask the only question that matters. How much additional retirement spending does that $864,000 fund? None. 0. He was fully funded at 57. The life he wanted was already paid for. Every dollar after that went somewhere, but it did not go into his retirement because his retirement was complete. Where it goes is partly to the government, on a schedule. At 75, his balance is $2,906,443, and the required minimum distribution is $118,148. That comes out whether he wants it or not, as ordinary income stacked on top of Social Security. And here I want to be precise, because it would be easy and dishonest to tell you the tax code robs him. It does not. His average tax rate on that distribution is 15.9%, and he deducted those contributions at 22%. On tax alone, Vincent came out ahead. He also dies with the largest estate of anyone in this video by a comfortable margin. He simply is not the one who gets it. He traded 8 years of his life, his 50s and his early 60s, the years he was healthiest and most able to use them, for money that became somebody else's inheritance. That is not a tax mistake. Vincent did not make a tax mistake. He made a time mistake, and time is the one input nobody can rebalance later. So Owen fails by stopping short, and Vincent fails by never stopping. The answer sits between them, and it is not a point. It is a band. For this household at 57, the bottom of that band is $1,205,042. The top is $1,566,555, 30% above the bare number. That buffer is not padding, and it is not caution for its own sake, so let me show you exactly why it is there. The bare number assumes a smooth 5% real return every single year. Reality does not deliver smooth, so stress it. At 100% of the number, if the next decade delivers 3% real instead of 5, the portfolio is gone by 79. At 110%, it survives 4% comfortably, but 3% still kills it at 86. At 120%, 3% survives, just barely running out at 94. At 130%, 3% is fully absorbed, and it takes a sustained 2% real return before the plan fails at all. That is the entire justification for the band. The distance between the bottom and the top is the price of not depending on an assumption you have no control over. Below the band is Owen. Above it is Vincent. And inside it, something specific becomes true that is worth stating plainly. Inside that band, additional contributions stop changing your retirement and start changing your estate. That is the line. It is not a tax line and it is not an investment line. It is the point at which the money stops being for you, which is the answer to the question in the title. You can stop saving for retirement when your portfolio enters that band. Not when you feel ready, not when you hit a round number, and not when you reach a particular birthday. When the arithmetic says the life you want is funded, with enough margin to survive a bad decade. One last thing about that band, and it is the reason this video has any urgency at all. Our household enters it at 57 with $1,320,694. By 58, they are at $1,411,000. By 59, $1,506,000. And at 60, they pass $1,606,000, which is above the ceiling entirely. 3 years. That is how long a normal saver spends inside the window between saving too little and saving past the point of usefulness. 3 years with no notification, no statement, and no advisor flagging it. In the middle of a working life that has trained you for 3 decades to never look up. That is why almost everybody sails straight through it. So what actually changes on the day you land inside the band? There are 2 honest answers, and which one applies to you is a question about your life rather than your spreadsheet. The first is that you stop working. If the portfolio funds the life, then the years themselves are now the thing you are buying, and every additional year at a desk is purchased with time you cannot replace. The second, and the one most people choose, is that you keep working but stop overfunding. Contribute enough to capture your employer match in full and not a dollar beyond it. The match is an immediate return of 50 to 100%, and there is no argument for leaving it behind at any balance. But everything above the match threshold is now genuinely optional. And optional means convertible, into shorter hours, into a career you would actually choose, into a business, into time, a few things not to do. Do not stop the match ever. Do not sell